Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone.
Today, we are taking a deep dive into just an absolutely extraordinary mix of events. We're pulling knowledge from recent excerpts published across Yahoo Finance, CNBC, and Bloomberg.
And we're really looking at three massive fault lines that are, rocking the markets right now.
That's right. There's a high-stakes domestic financial policy battle, escalating global security risks, we're talking Greenland and Iran, and then the early signs of Q4 corporate performance.
And that's all tied together with a really profound warning about AI.
Yeah, an existential one.
So the mission for this deep dive is critical. We need to understand how these political pronouncements, whether it's about capping credit card rates here at home or territory disputes in the Arctic.
How they immediately translate into real-world market volatility.
Exactly, and investor uncertainty. We're seeing policy literally moving prices in real time, and the underlying theme is, well, it's just unpredictability.
A lot of it.
Okay, so let's unpack this. Let's start right at home with that domestic financial policy battle. It's brewing right as the big banks are releasing their Q4 earnings.
And the spotlight, really, it isn't even on the earnings themselves. It's on President Trump's major proposal to cap credit card interest rates.
A proposal that was just sort of dropped out of nowhere.
Dropped via a Truth Social post last Friday, yeah. It called for, and I'm quoting here, 1-year cap on credit card interest rates of 10%.
10%.
10%. And the president stated that banks not complying by January 20th would be in violation. But, sources across the board, from analysts at CNBC to commentary in Bloomberg, they all noted the same thing.
Which is what?
The actual mechanism for implementation is, it's incredibly unclear. Is this a new executive order? Is he expecting a voluntary action? Does it need new legislation? Nobody seems to know.
And the financial sector is, I'm guessing, not thrilled.
They're unified in their opposition. They are pushing back hard. You have senior executives from the nation's 4 largest banks, JPMorgan Chase, Bank of America, Citi, Wells Fargo, all saying the same thing.
They're saying affordability is important, but
this cap would be nothing short of disastrous for the economy.
Okay, so what's their specific argument? What's the mechanism of disaster they're pointing to?
It's pretty direct. Bank of America's CEO, Brian Moynihan, stated bluntly that bringing caps down would likely result in a significant slowdown in the economy.
Why? What's the reason?
Because it necessitates what he called restricted credit. It's simple, really. If banks can't charge enough interest to offset the risk of someone defaulting,
They just stop lending to them.
they stop lending,
Yeah.
especially to higher-risk customers.
And Jamie Dimon at JPM was even more specific, wasn't he? He mentioned the impact on subprime customers.
He did. He said the impact would be dramatic on subprime. And you see the immediate paradox here, which is really the crux of the bank's whole argument.
That the very people the cap is supposed to help.
Right, those with lower incomes, maybe higher credit risk, they're the ones who might lose access to credit entirely, which could force them into, less regulated, much more expensive options like payday loans.
So are the banks exaggerating here? I mean, their revenue's on the line?
Of course they're prone to exaggeration, but the financial modeling seems to support their fear. Analysts estimate this 10% cap would hit the large bank earnings before tax by about 5 to 18%.
That's a huge hit.
It is. And for the specialized card lenders like Capital One or Synchrony Financial, the numbers are even more stark. Some analysts suggest their earnings could be wiped out entirely.
Wiped out. Wow, that's not just a slowdown. That's, like you said, a fundamental restructuring of their business model overnight.
Exactly. And all this friction is dominating the headlines right as these same banks are trying to report their Q4 earnings.
We saw the market reaction last week, right? JPM, Wells Fargo, Bank of America stocks all fell. What was it, 5 or 6%?
It was, and Citi dropped over 7%. Jim Cramer on CNBC, he summed it up pretty well. He said the numbers themselves were generally solid, but investor expectations were sky high.
And management's cautious commentary? Just panis. It put buyers off.
Especially with this regulatory cloud hanging over everything.
Yeah.
And you can actually see the banks bracing for this potential hit. Look at JP Morgan.
They just closed that huge deal for the Apple credit card partnership from Goldman Sachs.
They did. But to cushion the risk in that massive new portfolio, JPM set aside a staggering $2.2 billion credit provision against potential future losses.
$2.2 billion. So for our listeners, what does that provision really signify in this context?
It's JPM putting money aside today because they see that political and economic volatility could lead to more people defaulting later.
Or
Yeah.
that this 10% cap could just destroy their ability to make money on those balances.
Precisely. It's a real-time risk calculation based on what is still, a pretty ambiguous political threat.
It also has huge implications for individual growth stories. I'm thinking of Wells Fargo.
Oh, absolutely. They're trying to grow aggressively now that regulators have loosened those restrictions tied to the fake account scandal.
And their growth strategy is centered on consumer credit. Their card fees rose 8% last year to over $6 billion in revenue.
So they are explicitly betting their entire post-scandal recovery on consumer debt revenue. A 10% cap doesn't just hit their earnings.
It cripples that specific growth strategy they just launched.
Which is why JPM CFO Jeremy Barnum delivered that clear warning. He said if poorly supported directives radically change our business, then everything's on the table for shareholders.
So the uncertainty isn't just the policy, it's the sheer ambiguity of how it would even happen.
And the speed, that's the key.
Okay, so domestic policy is creating this radical uncertainty in finance. But this friction is playing out globally, too, on completely different stages. Let's pivot to the geopolitical risks.
And first, we have to turn to the Arctic and the truly bizarre standoff over Greenland.
Bizarre is the right word. President Trump is insisting that taking ownership of the territory is central to U.S. national security.
He's deeming anything less unacceptable, which led to a high-stakes White House meeting with U.S., Danish, and Greenland officials.
A meeting that ended with fundamental disagreement.
That's the only conclusion they reached. The public statements are incredibly stark. Greenland's prime minister said, "We choose Denmark, NATO, and the EU." Very clear.
And what would the diplomatic fallout be if the U.S. were to just proceed?
Monumental. That's the word from former Iceland President Olafur Grimsson. He warned this kind of action risks the stability of NATO itself.
But what's so crucial here, and Grimsson pointed this out, is that the U.S. already has extensive access to the region.
We do. Through the 1951 Greenland Defense Agreement, it basically guarantees us freedom for bases and operations already.
Which suggests the drive for actual ownership is, from a defense perspective, kind of redundant.
It makes the policy imperative very confusing. Grimsson suggested, according to the CNBC excerpts, that the whole fixation might just stem from Trump's background in
real estate. That
a leader trained to think about acquiring locations is applying that same worldview to geopolitics.
Wow. It's hard to imagine something as big as NATO stability being risked over what is essentially a giant real estate negotiation.
It speaks to that same difficulty we just talked about, discerning the policy mechanism. We see the rhetoric, but the strategic underpinning seems questionable, to say the least.
Meanwhile, the other geopolitical risk involves Iran. And here, we saw an almost immediate reversal in market sentiment.
That's right. The U.S. had previously threatened military action over the government's crackdown on protesters, which, obviously raised fears of conflict and oil supply disruption.
But then President Trump softened his tone on Wednesday.
He did. He said he was assured the killing in Iran is stopping, and there was no plan for executions, and that he would watch it and see.
And this immediately lowered those supply concerns.
Immediately. And oil prices dropped significantly. U.S. crude fell 1.55%. Brent crude fell 1.42%. It's a textbook example of a political statement directly relieving market fear and driving down a global commodity price within hours.
And yet, despite that one bit of relief in the oil market, the general background noise of uncertainty Greenland, the credit cap is still fueling safe haven assets.
It is. Our sources confirm gold and silver are currently smashing records. It suggests investors are still incredibly anxious about the overall climate.
And that chronic uncertainty is also showing up in the bond markets, right?
Subtly, yeah. U.S. Treasury yields nudged a little higher Thursday. The benchmark 10-year yield was barely higher at 4.143%, the 2-year at 3.522%. Investors are they're parsing everything. Geopolitical risk versus interest rate expectations.
And volatility seems to be the one consistent variable.
It's the only constant. So now let's shift from that policy instability to the relentless engine of technology and corporate performance.
Because while policy is causing all this havoc in banking and commodities, the underlying tech momentum, it's just crystal clear across the Atlantic.
Absolutely. You look at Taiwan's TSMC, the world's largest contract chip manufacturer, they reported a record 35% increase in fourth quarter profit.
Which beat all the estimates, right?
Smashed them. And it's thanks almost entirely to strong demand for artificial intelligence chips.
What's so fascinating is how tangible that demand is now. It's not just hype anymore.
Not at all. These chips are driving massive revenue for AI, infrastructure data centers, high-performance computing, the large language models everyone's building. It's a foundational boom.
And that news caused an immediate dramatic ripple effect in Europe.
It sent European chip stocks soaring on Thursday morning. The Dutch equipment maker ASML, they popped 7% initially. ASM International gained nearly 10%, and BE Semiconductor gained over 5.5%.
So the AI race is creating these massive record-breaking earnings that are just completely disconnected from the political risks we were just talking about.
It's a separate world. And this backdrop sets the stage for Goldman Sachs, which reports Q4 earnings before the bell today. Expectations are really high.
They're looking for what, $11.67 ETS and $13.79 billion in revenue?
That's the consensus. And analysts expect they'll benefit precisely from the volatile markets that these presidential policies are creating.
And there's the true financial paradox of the week. The same political volatility that threatens the consumer lending business for the big banks.
Is actually boosting the trading desks at firms like Goldman.
Right. Volatility means opportunity for trading. Plus, Goldman's asset and wealth management division should see gains because global stock markets have stayed pretty buoyant, driven by all this tech momentum.
It basically creates two different worlds, right? Policy uncertainty harms institutions that rely on predictable consumer debt, while that same uncertainty benefits the sophisticated trading operations that thrive on rapid price swings.
And this massive investment, this technological surge, it brings us to a really profound warning that we have to talk about.
A warning from Warren Buffett. He has compared the risks of rapid AI development to the development of nuclear weapons.
It's a comparison that's clearly designed to shock because it's so powerful.
It is. Buffett said the risk is that even the smartest leaders just don't know where AI is headed. He said unequivocally, the genie is out of the bottle.
He even echoed J. Robert Oppenheimer's famous statement about the atomic bomb. He said AI changes everything in the world except how people think.
And that quote, that is the core of the risk, isn't it?
It has to be. That human wisdom and our regulatory systems, they just can't evolve fast enough to manage a technology that fundamentally alters global power.
Exactly. Buffett wasn't talking about losing money. He was talking about an enduring existential threat. He pointed out that we've seen nuclear proliferation spread from one country to 8 going on 9.
And he sees AI proliferation as a similar kind of unsolvable threat.
An enduring one. He explicitly suggested this is a threat that even his considerable fortune couldn't do anything about, which it just brings a certain gravity to the conversation that goes way beyond investment strategy.
So when we put it all together, what does this all mean? Today's sources show us a global financial system that is just. It's battling on all fronts.
Simultaneously, you have these concrete policy threats at home, like the credit cap that could completely restructure consumer lending.
And at the same time, you have high political instability abroad, whether it's this bizarre territorial dispute over Greenland or the volatility around Iran.
And all of this friction is happening while technology, specifically AI, is driving these massive record-breaking earnings.
At a pace that the world's most respected investor compares to an existential risk.
The volatility we see, the drop in bank stocks, the instant reversal in oil prices based on presidential rhetoric, it all just underscores how profoundly sensitive global markets are to these political announcements.
Announcements that often lack clear legislative backing or even, strategic coherence.
Right. The common thread here is the increasing difficulty in just discerning the policy mechanisms and the long-term intentions behind these major political announcements.
So a final thought for our listeners.
Yeah.
We know the genie is out of the bottles for AI, but given the instability created by this unpredictable domestic policy and this geopolitical friction, should investors be more concerned about the technology itself or about the human decision-makers controlling the world stage?
A question that moves far beyond quarterly earnings, and one worth considering as the markets continue to react to every single headline.
We'll see you all tomorrow morning with new headlines from major financial magazines.